when you dey look at merger and acquisition, I know say you don good with merger and acquisition. Company may even decide to expand their business through merger and acquisition. Alternatively, any of these method can be used either through organic growth strategy. That is, when you say organic growth strategy, you are building a new business from scratch. 1, 2, it could be through joint venture. 3, it could be practicing, and 4 could be strategic alliance, and 4 could be either through license. So let's start with merger. So when you talk about merger is the coming together of two or more companies virtually of the same size, isn't it? Just coming together. When two or more companies comes together, is merger, virtually of the same size. But however, when you look at acquisition is a purchase of all, or is a purchase of a small company by a large company. That is A swallowing B. So B is inside A is called what? Acquisition. Means you don't acquire am. So if A swallow B, means an acquisition, whereby it's the purchase of a small company by a large one. So you can say it's takeover. A small company acquire a large one. So there are type of merger. We have conglomerate merger. That is, when you say conglomerate merger, is a type of merger that is the coming together of two companies in different line of business. Is what type of is among the type of merger, which is conglomerate merger. Conglomerate, when two or more company comes together from a different line of business. We can't get horizontal merger. When two or more company comes together in a similar line of business, is what horizontal merger. Vertical is when two or more company comes together in the same industry. So the things I want you to understand is that conglomerate merger is different line of business, horizontal is similar line of business, and vertical is the same line of business. So now let's look at a header. Let's say the motive of merger and acquisition. Let's look at the motive of merger. Why do people merge, and why do people go into acquisition? Now, when you look at that aspect, we are looking at one of the motive of merger and acquisition. One is to increase shareholders' wealth. 2, for expansion, which is also known as for growth purpose. And 3, to increase synergy. And 3, to bootstrapping of earnings. And 4, to achieve diversification, to diversify. That is why people go into merger and acquisition. And 5, for tax savings purpose. If you refer this for tax savings purpose, we are talking about the capital structure. If you remember capital structure theory, when people try to save tax by what? By merger. You merge to save your tax and all that. So let's look at the advantage of what? Merger and acquisition over organic growth strategy. These are also 10 to 15 markers. So the advantage and the advantages of merger over organic growth. Normally it's one of them is it is a faster way of achieving expansion, right? So 2, again, is it gives you opportunity and privilege to have access to new market, new customer, and even new product. And 3, you have this kind of ability to enter into a new market with ease, to set up a new business that would that would be difficult if you are to just invest on your own because of what barriers to entry. And 4, you have this access to overseas market where business cut across national boundaries. And 5, it may also result in an operational synergy, saving in cost or increase in revenue. It also have this access to intangible assets of the company. When I mean intangible assets, I'm talking about the goodwill of the company. Let's now look at the disadvantage of merger and Let's look at disadvantage of merger and acquisition. When you talk about this disadvantage of merger and acquisition, we are looking at the reduction in proportion of share held by shareholders. When I mean reduction in proportion of share held by shareholder, remember when you merge or sell your company, or when a company acquire a company, what happens? There's a dilution in ownership of the company. If peradventure the ownership of the company is 100%, when you are merging or someone is acquiring your company, you are selling a proportion of it, let's say 10%. It invariably means that you don't have that 100% ownership again. Rather, you have 90% and you have sold out 10%. That has reduced to dilution of ownership of your company, isn't it? 2, it may be expensive for that of merger. Merger may be expensive, which is 2, which is a disadvantage. And 3, there's deficiency in organic structure. That is the deficiency in what? In organizational structure, culture, and even pay system. So this they may be different in what? Organizational structure, how these people are being managed, how the organization is being managed. So you have to be able to adapt to it. So there's disadvantage on it. Even the pay system, there could be an increase. You could even talk about this, your merger and acquisition. Remember when you were telling me your firm want to go into merger and acquisition also. So this may also lead to what? Integration problem. So there may be integration problem. 4 or 5, it lead to exposure of business risks of the company. Remember, when you are diversifying into a different line of business. So it's different from your existing business, which is your business risk. So you are diversifying into another line of business. And if you are diversifying into another line of business, automatically what happens? You have an additional business risk. So there's an additional exposure of business risk. There's also 5 or 6. There's also an exposure to what? Financial risks. So all these are things you should take note of. I don't know if you are getting me now. So the next thing I should just look at, let's look at what we call the friendly bid and the hostile bid. You also see it for 10 to 15 marker or 20 marker. Now let's look at the friendly bid. When you say something is friendly bid, a bid is actually friendly if the terms of this bid are favorably to both parties concerned. Who am I talking about? I'm talking about the favorable parties, both parties concerned are one, which is the predator and the acquirer. The acquirer and the predator company. So a friendly bid, I want to buy your company. Is it favorable to you? The amount I'm paying in terms of consideration, is it favorable to you? Is it also favorable to the seller? Is friendly bid to both parties, favorable to both of them? For example, if the price offered by the acquirer is higher than the intrinsic value of the target company, they will benefit from the both. And that brings us to option theory. When I'm talking about the intrinsic value, please learn how to calculate that also with your textbook. Very, very important. So now let's look at the hostile bid. When I look at the hostile bid, I'm talking about this is where the price offered is not favorable to both to the target company. I come again. When I say the hostile bid is a situation where the price offered is not favorable to what? To the target company. In this case, if the target company will have to adopt a strategy in order to prevent this hostile bid. And one of these method or the various method that can be adopted by this target company to prevent this hostile bid are: 1, he should restructure the assets of the company. 2, he should seek government injunction. 3, he should persuade the shareholders not to sell their share by promoting them, I don't know, or by promising them a better prospect and share price of appreciation. And 4 or 3, they should look for what? For a white knight. When I mean a white knight, a company with what? A more friendly bid. And 5, they should look for a yellow knight. When I mean a yellow knight, a company that negotiates merger instead of acquisition. And lastly, they should look for what? A Peckman defense. Now, the next thing I want to look at is factor to consider in pricing a takeover. Okay. Now, when I'm trying to talk about factors that we have to consider whenever we want to price our takeover, because if you look at the factor, you have to consider yourself. In short, why do I want to take over a company? Please take note. If I'm buying a company, is it beneficial to my company? If it's not beneficial, therefore I don't think of considering the price I want to pay. So for you to consider the pricing of takeover, you have to consider the synergy. What is the benefit of you actually acquiring my company? 1, I have to consider my synergy. And 2, I have to consider my risk exposure. Of what benefit? When I take over this company, will it increase or actually affect my risk exposure? I'm talking about the financial risks I just mentioned, the business risks I just mentioned. Of course it will, because if you are diversifying, you don't use WACC, you use what? You use your CAPM theory, because CAPM theory talks about what? Variety of risks. different from the existing risks before you diversify into a line of business. So you have to consider the risk exposure, right? You have to consider the valuation assumption used. The valuation assumption used, does it actually reflect the real due diligence that we seek? You have to also consider the financing. Do you have all it takes to finance the company? Will it resort to debt and equity finance, or will it just resort to only equity finance? You have to consider real options. These are things you should consider. Let's look at one, the synergy. For instance, when I talk about synergy, it's just a concept that assumes that the value of a two company when combined will be greater than their individual sum. Is normally a synergy. And normally, I can love this question whereby they will ask you what are the types of synergy we have. There are three kinds of synergy. When you acquire a company and your revenue increases, is what we call synergy. Revenue synergy. This occurs when the acquisition of a target company will lead to an increase in the overall revenue of that company. It's called the revenue synergy. We also have cost synergy. As a result of acquiring this company, will it increase or decrease the value of the costs incurred in that company? If it will decrease the cost, it will increase your profit. But if it will increase the cost, it will decrease your profit. And if it will decrease your profit, you will have problem. So the next one is a cost synergy, isn't it? And the last one is a financing synergy. As a result of acquiring that company, does it give you opportunity and privilege to be able to finance the company more profitable? Will you have access to individuals who will be willing to finance your company at will? Then you pay them back in form of interest in terms of capital. So all these are factors you should also consider. Then they will now have other frequent examining questions in ICANN, like we have something like reasons for high failure rate of merger, because if you discover under capital structure theory, you see some issues like when a company have this mentality or understanding from what they call it Miller and Modigliani theory of 1958 and 1963, when they came up with different theory that they said when you introduce debt finance, you have this benefit of tax shield, and it is a lower interest to the shareholder and other things. But you have to know that there are also reasons for high failure in terms of merger. Such one of them is purchase price are often high, and two, we have the expected synergy at the end of the day might not occur, and three, the valuation error or overvaluation there may be a valuation error or overvaluation at the end of the day, or let's say integration problem, like I've always said, in terms of the disadvantage of merger is also one of the reasons for high failure of merger. And three, we also have competitor might react to an acquisition by introducing a new competitive strategy, and this lead to a very high problem self. So there could also be problem in establishing an effective management control. Remember, when you merge, you are bringing in set of a new management into this company. So ability for you to derive or probably set up a new standard, rules and regulation that will guide this set of management is another problem entirely. Now let's look at step or methodology or ways and how to value a company, no matter how the examiner may want to set this question. And that brings me to the next audio or voice note. Now, because they are under merger and acquisition, we have what we call dividend valuation model. We have the PE ratio valuation model. Please, you have to be very conversant with these two. We have the free cash flow method. Are you getting me now? When I mean the free cash flow method, that involve cost of capital being used, so you have to consider that one too. We also have other method like financing, merger and acquisition. These are the three method other merger and acquisition. You have to study them very well and thoroughly. But however, like I said before, now I'm going to look at what step in doing what merger and acquisition, and how do we go about it. The first step you have to do in merger and acquisition, step one, try as much as possible to ascertain the value of the target company and the value of the acquirer before merger, using the applicable valuation method. That was why I said the information given to you in the question will determine the method that you are going to use to value that company. You have to determine the information given. When you see the information given, you will now be able to establish the value before acquisition of the target company and the value of the acquirer. The step 2 is to ascertain the value of the combined company using the applicable what model or method. And step 3 is to calculate the maximum price payable if required by the examiner. But is always asked in the ICANN exam. So what am I saying? Whatever you have gotten in step 1 and step 2 will give you what? Will give you the maximum price. How do I mean? The value of the combined company minus the value of the acquirer will give you the maximum price payable. I come again. I say step 1, you ascertain the value of the what? Of the individual company before acquisition using the applicable what? Valuation model or techniques. 2, I said ascertain the value after acquisition of the what? Of the combined company using the what? The applicable what? Model or techniques. Now say calculate the what? The maximum price payable. The maximum price payable if the examiner required. That is what I said. Not mandatory, but the examiner will always ask you which is the what? The value of the combined company minus the value of the acquirer will give you the maximum price payable. Now step 4 is to determine the effect of the transaction on the wealth of the shareholder of both company if the examiner also what demanded for such information. Like I've told you, it's not difficult. The value before acquisition of the acquirer and the value after acquisition of the acquirer minus the value before acquisition will give you the effect or what of the transaction on the wealth of the shareholder. See, this thing I'm telling you, Baba, you will not see it in that your textbook you are reading. I repeat again, that one you are reading now, you won't see it there. I said this step 4 is to determine the effect of the what? The transaction or what on the shareholders of both company. You can do that. And that question is usually up to 15 marker or 10 marker. I repeat, the value of the acquirer before acquisition and the value of the acquirer after acquisition. If you minus the value after acquisition of the acquirer minus the value of the acquirer before acquisition, if you minus it, it will give you the effect of the shareholders of the transaction of both of the transaction of the acquirer. For you now to get the effect on the what? The shareholder of who? Of the target company is the value before acquisition and the value after acquisition of the target company. So the value of the target company after acquisition minus the value of the company of the target company before acquisition will give you what? The effect of the transaction on the shareholder of both the company of the company. I don't know if you are getting me. Whatsoever you do will give you the value you have. So you cannot be able to write based or make your judgment based on the value, because when a company is acquired, it could be a gain to the acquirer or it could be a loss to the acquirer. If it is a loss to the acquirer, it will be a gain to the what? To the target company. So why if it is a gain to the acquirer, it will be a loss to the target company. Vice versa. That was why I said it depends on you, and you will never see it anywhere. And when you go to ICANN Park, you discover ICANN Pathfinder, you discover that because of students are unable to explain the effect on shareholders' wealth in terms of synergy or effect or gain or loss, they tend to allocate more mark than even the calculation itself. Back on what we actually have in frame, when question is given to you, just like what we have in our screen now, you have to estimate the value of the acquirer company. You also estimate the value of the target company. When I mean the value of the company, you have to run a calculation that reflects the value before acquisition, before merger, and the value after acquisition, after merger. So the value before acquisition of the acquirer company is X3, right? And the value of the target company before merger is X2. So X3 plus X2 will give you X5, which is the total value before acquisition of both the acquirer company and the target company. Then the next thing you should estimate on it is the value of the acquirer company, which is X5, which is value after acquisition or merger, which is X5 for the acquirer company, and the target company, the value after acquisition of the target company, which is the agreed price, should be X4. So X5 plus X4 will give you X9. Now, most examiner will want to ask you to estimate the synergy. What will be the benefit? What will be the side effect, the gain that will accrue to both the acquirer or the target company? You can see that in total or the individual value in terms of the acquirer and also the target company. Now, for you to actually ascertain the gain, you have to deduct x5 from x3 will give you x2, which might be a gain to the acquirer or a loss. Then you have to estimate the effect of synergy as well in target company, which is what the x4 minus x2 will give you x2. So the x2 plus x2 will give you x4, which is the additional value created as a result of merger and acquisition. Like I've said before now, the examiner, when question is given to you, the examiner will not actually identify which method you are to adopt, either the PE ratio or any other method or techniques used in valuation. So the question should actually tell you what to do. So once you are able to gain the additional value created, which is the x4, now their side effect or benefit. Sometimes the acquirer may decide to acquire the target company. At the end of the day, it will be a loss to them, while it will be a gain to the target company. So you have to ascertain the synergy to know if it's an advantage to the acquirer or to the target company, which is what we have in our system here. Now, in summary, most examiner, if the examiner is that good, what he does is he might give you value before acquisition, which is the total value of the acquirer or the target company, which is x5, and equally give you value after acquisition, which is x9, and ask you to calculate the synergy. So if you are meant to calculate the synergy, you have to deduct what x9 minus x5, which will give you what x4, which is the synergy as what additional value created, isn't it? Now, another way the examiner can do this is he might give you the value before acquisition and give you the value of the synergy of the total company, which is the acquirer, and also the target company, which is x5 and x4, and ask you to calculate x9. So you have to work back. So it will be x5 plus x4 will give you x9. So sometimes the examiner also might tell you estimate the agreed price, most especially if the value before acquisition is given for the acquirer company and value of the target company is given before the merger and as well, which is x3 plus x2 will give you x5, isn't it? Then the agreed price is also given, which is x4. Then the total value after acquisition, which is x9, will be given. They will ask you to calculate the x5, which is the difference, the benefit created after acquisition, which is the acquirer company, which will be x9 minus x4, which will give you x5. Now, sometimes they may give you the difference, which is the x5, for that of the value of the acquirer, which is the x5, which is the difference, and also give you the acquisition, the acquirer company value, which is x3, the target company, which is x2, the total value of the value before acquisition, which is x5, and they will tell you to calculate the agreed price. So what do you do this time around? You sum up the value of the acquirer company, which is x3, the target company x2, which is x5, which is the total value before acquisition. Then you estimate the agreed price. The agreed price is s4, and the total value is given as x9. So it will now be x9 minus x4 will give you x5. So this is what we have for acquisition and merger.